This is Chapter 16, Video 3. Let's launch. Okay, so for this video, we've got the learning objectives to learn the compliance requirements and then about estimated tax payments. So in corporate tax liability, your world got very easy if you do corporate tax returns. Basically, they changed the corporate tax return compliance, the percentages. It used to be, and I used to have a couple quick finders here. I think actually this is the small business one. Yeah, I don't have any of the 17s and before, but it used to have a little tax table of, if your corporation made this much money, this is your tax rate. It used to be a progressive tax system, just like it was for individuals. But then in 2017, when they did the Tax Cuts and Jobs Act, they moved it to a flat rate of 21% applied to all taxable income. So it actually makes it real easy for you in order to determine potential tax liability when talking to your corporate clients. On the compliance side, so corporations report on 1120. Small corporations, you're allowed to use the Schedule M1. If you take a look at an 1120, and I recommend that you have one of these when you're looking at this video, the M1 is a very small book-to-tax reconciliation form that actually gets filed. It's usually, I think it's on page 5 of the 1120. And then you take a look at it and you'll have that actual M1, the M1, M3 that they have there, isn't just for corporate tax returns. It's also for partnership tax returns as corporation returns. You'll have to file either an M1 or an M3. But if you're a large corporation, you have to go from an M1 to an M3. And the M3 is a longer form. I believe it's 4 or 5 pages. Each year it's changed. And if it doesn't meet the requirements to file an M1, you'll have to file an M3. It's more detailed. To be honest, for most corporations, there's a lot of holes because there's a lot of stuff that doesn't apply to them, but it does give them a little bit more detail and a little more fidelity, so that the IRS is much happier with that. And so we actually refer to these book to tax adjustments as M adjustments. Okay. Corporate tax returns are due 3.5 months after the end of close of the year. So if you're a corporation, your calendar year, that's April 15th. If you are a June 30th end of the year, there is an exception where you have to file a little sooner. I haven't actually done any of these because, most of my clients are all calendar year. So it's different. There's an automatic extension for a 6-month extension for October 15th for calendar year corporations. And so, again, if you're getting to the end of your tax season, you can't get the corporation tax return out, you can go to and you can do a 6-month filing extension in order to be able to do this. Then you also have consolidated tax returns. Now, like we said in a previous video, if you're 80% or more owned of another company, so if your corporation owns 80% or more of another company, you will have to file a consolidated tax return to be treated as one corporation. Now, obviously, if it's an 80% or a 90%, there's going to be an item in there that says this is not taxed at this level and all that sort of stuff because of this, blah, blah, blah. But, that's going to take into account the other corporation's tax returns also. And so this is a Schedule M1. This is what I was telling you. Go ahead and look at the tax return. This is what they look like. This is the one I do 99.9% of the time. I've done a few, like I said, I've done a few M3s in my past, but most of the time it's one. And you'll notice that there's not a lot of fidelity here. I believe it's about 1/4 to 1/3 of one page, as opposed to the M3, which has multiple pages in order to do it. So estimated payments, just like for individuals, corporations have to make estimated payments for federal tax liability. If you have federal tax liability of $500 or more, you're required to pay that over time. In other words, it's like J.G. Wentworth. IRS says it's our money. We want it now. We don't want to wait for an entire year to get it. So what they do is they say, look, you're going to calculate what your estimated tax payment's going to be, and then you're going to pay this. And if you don't make a payment, you'll have an underpayment penalty, and that'll be based on the annual payment requirements. Now, there is a way that if you have a corporation that gets money differently throughout the year, that you can annualize that and sometimes that can actually reduce a lot of under withholding penalties. Because if you think about it, say I take a CPA firm and say it's a C corporation, because there are CPA firms that do C corps. Obviously, I'm going to get a big chunk of money end of April, beginning of May. That's when I'm going to get a huge chunk of money. First 3 months of the year, probably not as much. And then third quarter, probably not as much. Fourth quarter, I'm going to get a whole bunch of it because I'm going to have all the other tax returns that we waited till September and October 15th to file. And so what'll end up happening is you can actually fill that out so that you can get that done. So you could say, hey, look, this is how the under withholding payment should be done. And actually it helps corporations, because if you think about it, if I got a whole bunch of money during tax season, I'm going to be able to make a good estimated payment as a result of that by using those amounts. And so that's actually very valuable. The annual required payment, like I said, is 100% on prior year or 100% of current year, 100% of estimated payments using the annualized method. That's what I was talking about earlier. Rules for large corporations. If you have taxable income of $1 million or more a year, you may use prior year liability for first quarter payment only. Then they're going to go with current. And the reason why they say that is, if you're a large corporation, you probably have the sophistication amount to be able to calculate your stuff and remit timely. So you should be doing that. All right. So this is an estimate of how they do it for the annualization amount. They say, this is the taxable income for the first 3 months of the year, blah, blah, blah. And then they estimate this out here, and you can use this as an example in order to get a better grasp of this in your learning. And then this one right here is how you would do it under the annualized method. That's actually very useful. In the previous one, they're actually taking the whole year and then just breaking it up into 3 chunks. This one, they're actually doing it where it's got a little more fidelity, but if you can actually get this done, you might be able to save your clients a lot of money. All right. So that's all I got to say about this real short video. Very happy about that. And, again, we've wrapped up corporate operations and on to chapter 17 after this, and looking forward to seeing you at the next video.